Good afternoon and welcome to this week's Elite Traders Club education session for November the 4th, 2015. Today's topic is Japanese candlesticks. So let's get underway. And first and foremost, as usual, our disclaimer: the content of today's education session does not constitute a recommendation, nor does it take into account your investment objectives, financial situation or particular needs. So before making an investing decision based on the general advice and the education in today's presentation, please consider whether the advice is appropriate in light of your financial circumstances. You can pause the video now and read the rest of the disclaimer at your leisure. Today's topic, Japanese candlesticks. We'll look at the difference between a typical bar chart and a Japanese candlestick, why we prefer to use candlesticks and why they are very useful, particularly in interpreting the balance or imbalance of demand and supply in the market. Alright, so on any stock chart there are 5 important pieces of information. There's the opening price, where the first sale of that stock traded at for that particular period, the high being the highest price that the stock traded at on that day, the low being the lowest price that the stock traded at during the course of that period, and the close, where the last sale of that stock traded at. And also the other bit of information on the chart is the volume, which is just simply the number of transactions in that stock for that particular period. So having a look at the bar chart here, we can see that there's different information that has been provided on the chart. Each bar has an open, it has a high, has a low and a close. The range of the price throughout the day is presented by the vertical bar, and the open is represented by a small notch or horizontal line on the left hand side of the actual range of the bar itself. The close is represented by a small notch, this time on the right hand side of the range, or the right hand side of the bar. The region in between the open and the close is referred to as the body, whilst the zone outside of the body is what we would refer to as a shadow. So this probably makes a little bit more sense when we have a look at an actual candle as opposed to a bar. So let's have a look at Japanese candlesticks. So here you can see that the area between the open and the close when we're looking at a candlestick is actually enclosed, if you like. So the difference between a bar and a Japanese candlestick, and that enclosed area represents what we call the body. Okay, so in a Japanese candlestick, that zone between the open and the closed part, or the captured part, if you like, is what we refer to as the body of the candle. And the parts of the candle that are extending from either end are sometimes either called the shadows, or alternatively they're often referred to as the wick. Now the body of the candles will be white if the close on that particular period is higher than the open of that period, and the candle will be black if the close of the period is lower than the open of the period. So there, the candle on the right hand side, we know it was a down period because the body of the candle is black, and that means that the close of that particular period, the closing price was lower than the opening price for that period. So this is I guess the main difference, and it's significant in that it helps us to decide who's in control during that particular period. A white candle clearly tells us that demand is greater than supply, so for example the buyers are in control, and a black candle, the one on the right, tells us that supply is greater than demand, i.e. the sellers are in control. Just want you to think about that for the moment, the concept of demand and supply. Now whilst we quite often talk fairly simplistically that demand is greater than supply, what we need to understand is that for every transaction there needs to be a buyer and a seller. So we need to go further, and rather than say that demand is greater than supply, because they're going to be equal, but really it's the demand pressure, if you like, that really has an impact on the supply levels. So whilst there has to be transactions going through, and for every buyer there has to be a seller, the pressure of that demand, the buyers are willing to pay higher and higher prices, so the pressure of that demand is exceeding the pressure of the supply. The people who are supplying at that point are quite happy to sell at those levels, but because the demand is there and it's quite frantic, the buyers are willing to pay higher and higher prices. So they're competing amongst themselves, if you like, in order to obtain the stock. And conversely, when we've got a black candle, we're really talking about the supply pressure. So the eagerness, if you like, of the suppliers, how keen they are to get out of the market compared to those that are demanding the stock, buying on the other side of the equation. So having a look at Japanese candlesticks, each candle tells a story about the balance between demand pressure and supply pressure. So we've got two candles here. What do they tell us? Well, clearly there's lots of demand. And how do we know this? Well, first and foremost, both candles are white, and that is that their close are much higher than their opens. What else do we know? Well, the close of the second candle is also at the extremes of its range. That is, it closed right on its high. And that really signifies a significant amount of demand. So very, very strong demand pressures being applied to that particular stock. And the only thing that stopped this candle going higher was the close of that particular period. So that's extremely bullish if you're a holder of that stock, and that's a great candle to see. If we compare this with the first candle there, the one on the left, it closed just off its highs. Now, why did it do that? Well, the only thing that came in towards the end of that particular session must have been some supply. So towards the end of that particular period, the supply pressure, if you like, was starting to exceed the demand pressure, and as a result, price started to recede a little bit and closed off its highs. Still, for that period though, the buyers were still in control, and therefore a white candle. If we have a look at these next two candles, we call them Maribozus, and Maribozu basically just means no shadow, if you like. And what a Maribozu really tells us, it tells us who is in control. And a Maribozu really means complete control, whether it's either the buyers or the sellers, so the bulls or the bears. So candles that are showing strong demand and little supply and have no visible wicks or shadows are what we call Maribozu, and also means shaven head in Japanese. The Maribozus can be either bullish, so the one on the left, clearly a bullish Maribozu, big white body on the candle. Certainly buyers are very much in control. Conversely, we have a bearish Maribozu on the right-hand side, and the sellers, or the supply pressure there, is clearly in control on that candle. So if we go a little bit further and we have a look at a couple of candles to see who is in control. Well, in the first candle there on the left-hand side, a white body on the candle suggests that the buyer's in control, and that's clearly the case, with the close being much higher than the open of that particular candle. If we compare this with the candle on the right there, at some stage during the day, that candle would have been big and white, with price closing, or price actually trading right at the extremes of that candle, so right up near the top of the wick there. And at that time during the market, that candle would have had a very large white body. But then during the course of the day, something happened. Supply pressure started to increase and turned what would have been a very bullish white candle at some stage during this particular period. The supply pressure has come into the market and forced the price down. So that supply pressure has really exceeded the demand pressure, so much so that it pushed the price all the way down below its actual opening price and sent the price lower for the day. And because price closed lower, or I should say lower for the period, that's why the candle on the right has a black body. Okay, so in doing so, what it has done is it's formed what we call a pin bar, and in this case it's a very bearish pin bar. So again, you can see pretty clearly that these two candles have a different story to tell us about demand and supply. Pin bar candles are effectively candles that have a very small body compared to a much longer shadow or wick. They tell a bit of a story about the battle of control, and they are quite often associated with a transition in price from one direction to another. The first pin bar on the left opened and experienced a good deal of supply in the market, so that was actually forcing the price lower. How do I know that? Well, there's the telltale signs there of that long wick, that long tail, which is telling me that at some stage during that time frame that candle was big and black. Now at some stage a significant amount of demand pressure started to enter the market and then really started to soak up all of that supply, and such was the pressure that it started to force price higher and higher, pushing it finally above its opening price before the period closes and we move on to the next period. So a huge amount of work has been done during the formation of that candle, and really represents a transition, if you like, between what was a supply-based candle midway through that period to very much a demand-based candle. And this is a really bullish sign, and it's what we refer to as a bullish pin bar. The second candle, however, when that opened, it experienced a high level of demand, and as such we would have seen a big white body on that candle as demand pressures crept into the market and pushed that price up to its to the high for the day. And at that stage it would have looked extremely bullish. The body would have been big and white and things would have been looking good. But again, then something happened. A huge amount of supply, so if you like, the supply pressure entered the market, was far in excess of the demand pressure, and as a result started to have an impact on the price, pushing the price lower and lower in the face of that dwindling demand. So just the impact of excess supply or excess supply pressure. So that supply continued to outstrip demand and resulted in the price continuing lower and lower and eventually closing below its open. How do I know that? Well, the presence of a black body means that price closed lower for the day. So again, a huge amount of work done in the formation of that particular candle as well. A very bearish sign, and as a result we call this a bearish pin bar. There's a couple of other things that we can consider when we're looking at candles. Rather than looking at individual candles, we can look at groups of candles, so we can start to blend them and see other patterns forming in the market as well. So candles showing strong demand and little supply that have no visible wicks, as the examples here, Maribozus, meaning shaven head, as we've talked about a little bit earlier. So the first one there, we've got a very bullish Maribozu, big white candle, shaven head, and that's followed by a very bearish Maribozu. So what does the end result look like if we were to merge these two candles together? That is a very bullish up day or up period, followed by a very bearish downward period. And you can see that the end result by combining these two is a very bearish pin bar. Okay, now whilst it's bearish, it's even more bearish when we consider it in the context of the underlying trend. If we're seeing this and we're in a very strong uptrend, then certainly it's evidence of lots of supply coming into the market, maybe some profit taking as an example. But if we compare this, we saw this particular formation during a downward overall trend, then this would be even more bearish. Okay, so what you need to do is consider the blending of the candles in alignment with the overall trend. Certainly a bearish formation, but even more so when we're in a downward trend as opposed to an upward trend. So again, we've got a similar situation in this. The main difference in this particular example is that first off, we have a very bearish Marubozu, big black Marubozu, where price opened on its high. That was the highest price for the day, and the rest of the day price just continued to be subjected to very, very strong supply pressure, and as a result, it closed on its lows for the day. The following day or following period, price opened right at its low. Demand pressures came in and pushed the price way back up. In fact, so much so was the demand pressure that it forced price higher than the previous day. Wonder what it was that made that change in the space of the next period, whether it was a 5-minute candle, a 10-minute, a daily candle, a weekly, a monthly. It really doesn't matter. It's the same psychology, the same pressures working in the market. Now, if we were to blend these two candles together, what would it look like? A bearish day followed by an extremely bullish day. So if we blend those two together, we're going to end up with what we would call is a blended pin bar. So blending those two candles together, and if you were to see that on a chart, then that would be a very bullish sign indeed. Particularly so if the underlying trend is to the upward side at the same time. Now certainly you'll see these sorts of formations, pin bars, when there is underlying downward trend. So the upward movement there, it might have been as a result of some speculative buying. It might be, we've got to start thinking about, well, what is it that's formed that the tail on the candle there if we were in a downtrend? And it might be that people were short and they therefore, as a result, having to get out of a short trade, you have to purchase. That could have added to the demand side and helped to form that wick. If we happen to see this in an overall uptrend, as prices being sold off during the course of the day, then the market realizing that those lower prices are very attractive and therefore attracting more bidding, if you like, or more demand pressure, and therefore helping in the formation of that pin bar as well. So really needing to have a look at not just candles in isolation, but as part of a broader trend makes much more sense. The pin bars themselves, when you have a look at the pin bars, you'll often see them in association with a transition of some sort, so a turnaround in trend, if you like, from bullish side, if you like, or demand side, to potentially a supply side sort of situation. So the three candles that you can see on the chart there at the moment tell us a bit of a story about some changing dynamics between demand and supply. On the left there, the first candle, we start off with a long white candle showing clearly that the buyers are in control, and then that's followed by, again, a bullish candle. And how do I know it's bullish? It's got a white body, price closed higher than where it opened for that particular period. So the buyers are still in control. And then something happens. Their dominance, if you like, is being challenged. And the clue that gives that away is the wick on the top of that middle candle. Clearly, there's evidence there of some supply coming in. Because at one stage, that second candle had a very large white body, but then as the supply entered and the supply pressure exceeded the demand pressure, it forced the price down, and as a result created that long wick at the same time. So certainly evidence that there's growing supply in the market. The following candle, clearly supply pressure is outstripping demand pressure, and as from the outset has really forced price in a downward direction throughout the remainder of that particular period. So with those three candles, we can see a transition from very much a demand-biased market, if you like, so dominance of white candles there. We can see the transition there, that pin bar, and then the follow through the following day where we're starting to get if you like, a little bit of a reversal, a transition in trend. And in this particular case, to be specific, it's a transition from a short-term uptrend into a short-term downtrend. So you just need to think about that in terms of whether you're in a supply-based market or a demand-based market. So upward trending or downward trending, and looking at those combinations and really seeking the more meaningful description, if you like, of what the overall impact of those candles is. So just some key points to remember. This is particularly for newer members of the Elite Traders Club. Japanese candlesticks tell us who's in control and are very useful for spotting transitions. You can use bar charts, but certainly, particularly when you're looking for those transition types of formations and pin bars in particular, they're a lot easier to see when you're actually using candles. Typically, we like to use black and white candles. It just helps to show the difference between demand and supply, a bit of the yin and yang in the markets, if you like. You can choose different colours, etc., but certainly I think best seen with black and white candles. And certainly if you're looking at stocks in an uptrend, then what we want to be seeing is predominantly white candles. If we're looking at stocks that are in a downtrend, as an example, then what you like to be seeing if you were looking to go short is predominantly black candles, and so really showing that there is certainly a lot of supply pressure on the downward side if you're looking to go short. Remembering typically we're long only using weekly charts, and in an upward trend then we're really looking for predominantly white candles. So hopefully that helps and gives you a little bit broader context for the use of candlesticks as opposed to normal price bars. Thanks for listening, and we look forward to catching up with you on Monday morning's weekly analysis session. Bye for now.